what you can see is that price dropped to the downside. This is the daily structure. So price took out this low points from the daily time frame. We'll have a break in market structure. You can see that within the 3-hour time frame, we are having this bearish move to the downside. We are having the bearish market structure because you can see we have the fall of price to the downside. Price pushed to the outside, rated the inducement. We have the fall of price. This is the inducement here. Price pushed to the outside, took out the inducement. We have our new lower high points. Price pushed to the downside, took out this lower low points. And then you can see this is the inducement here. Price pulled back, took out the inducement. We have a new higher low point. And hello traders, welcome to the Nexoel Trading Hub YouTube channel. In this video, we are going to be looking at external and internal range liquidity. The external range liquidity is the liquidity resting on previous highs and lows. These highs and lows are also used to define the market range. And then the internal range liquidity is the liquidity inside the defined range, meaning it is actually the liquidity within the external range liquidity. And this could be our minor swing structure, our price imbalance, and more. We must understand that the external and internal range liquidity forms our major and minor market structure. So guys, let's head to the chart so that you can actually understand how to identify the external range liquidity and the internal range liquidity. So guys, let's look at the charts here. You can see we have the bullish move to the upside here, and then we have the bearish move to the downside here. Now you must understand that the higher time frame helps us establish the external range liquidity, and then a lower time frame helps us establish the internal range liquidity. So now you can see that we have a bullish market condition in this particular side of the market. Now you can see this is the expansive move. Now within the expansive move, you can see we are having a bullish market structure. And then you can see within the corrective move, we are having the bearish market structure. Now you're going to see that the market here is breaking previous high points. We are having a break of structure to the upside, which is actually giving us the bullish market condition. So what you can see is that price within the expansive move is having also a bullish market condition. So now you can see that from this swing low points to this swing high points defines our external range liquidity. From this swing low points to this swing high points define our external range liquidity. From this particular swing low to this particular swing high, this swing low also to this particular swing high defines the external range liquidity. So the external range liquidity is actually our major market structure, major swing points within a market condition. That is the external range liquidity. So the internal range liquidity are actually the price movements within the major directional bias. The structure within the major directional bias defines our internal range liquidity. And that is what we can see here. Within the expansive move, you can see we are having this particular bullish move. And then you can see in the corrective move, we have the bearish move. So you can see that price actually moves to grab liquidity and then fill inefficiency. So you can see the expansive move pushed to the upside and then price raided this high points. So you can see we have a break of structure and then also a raid of liquidity zone. Now you can see these are internal range liquidity because these are structured within the expansive leg move, and these are also structured within the corrective leg move of the major directional bias, which is actually a bullish market condition. So you can see that when price actually breaks the previous high point, we have a new range. The expansive leg move forms the range of the market. So we are expecting a pullback for price to come raid the internal range liquidity and then fill up any form of inefficiency. So the market basically moves to grab liquidity and then fill inefficiency. So you can now see that the price returned to the downside, grab all the internal range liquidity and then fill any form of inefficiency. And then you can now see price created a new higher low point, instigated a higher time frame point of interest, and then we have an expansive move to the upside, and then price took out the external range liquidity. So in a bullish market condition, the market moves to grab the external range liquidity of a swing high points within the major structure. While in a bearish market condition, the market moves to grab the external liquidity of the swing low. You can see that within the internal range liquidity, you would also see that price gave us a change in market character here. This doesn't mean that the condition of the market has changed to a bearish market condition. No. If you can recall from the major and minor market structure video, I taught you guys this. So you would see that this is just the pullback leg move. So within the lower time frame, which is forming the internal range liquidity, we're going to be having a bearish market structure. That doesn't mean that a major condition of the market is now a reversal market condition. No. Now this is where we have our ideal reversal in the market condition. When price took out this ideal major swing low points. So price dropped to the downside and then price took out this higher low points. This is when we now have an ideal reversal in the market condition. So the market condition is no longer bullish but now bearish. So you can see that price took out external liquidity to the downside. So price took out this sell side liquidity. Now we have the pullback to the upside and then price gave a move to the downside. Now we can see where is our external range liquidity. It is from this swing high to this swing low. So you can now see we are having what? The pullback leg move. Price gave us the pullback to raid all forms of what? Internal range liquidity, fill up inefficiency. So the swing point of the minor structure gives us also a swing point that serves as the buy side liquidity within the expansive leg move when the condition of the market is bearish. Now when the condition of the market is bullish, the minor time frame swing low points gives us the internal range liquidity swing low where the pullback comes and then raids the particular swing low, and then we have price push in the direction of the trend. So this is the external range liquidity and then the internal range liquidity. The external range liquidity is actually your major swing point. The internal range liquidity are actually the minor structure within the major structure. So now let's look at further chart examples so that you can comprehend this knowledge on how to identify the external range liquidity and the internal range liquidity. So guys, let's look at this market condition. You can see the market condition here is actually bullish. We have price broke the structure to the upside. We have the pullback. We have a higher low, a higher high, a higher low, a higher high point, and then we have a higher low points. Now, what you're going to see is that this is actually our entire expansive leg move. Actually, there is a video in the YouTube channel that shows how to mark out ideal institutional market structure. In this video, I'm not going to stress on how to mark out ideal institutional market structure. I'm just going to show you guys how to determine the internal range liquidity and the external range liquidity. If you're really interested in understanding how to mark out ideal institutional market structure, then you can go to the description section to this video, and then you'll get the link to that particular video. And if you're new to this YouTube channel, please guys, can be a like, share, and subscribe to our YouTube channel. So guys, let's head to the charts. Now, what you can see is we have a break of structure to the upside. We have the first pullback and then price push further again to the upside. We do not have a valid high point here. So we see price pull to the downside and then give us the expansive leg move. Now price created this ideal higher high point because we have the push of price to the downside that raided the inducements. So we're going to assume this is our 4-hour time frame. Now you're going to see that when you drop to the 15-minute time frame within the expansive leg move, we're going to be having this bullish bearish market condition. Now this is the higher time frame inducement level. But then this is the inducement level from the lower time frame. So now you can see that when price dropped to the downside within the structure of the internal range liquidity, we have a change in market character. So what we are actually expecting from the higher time frame is to see the drop of price to come mitigate this decisional point of interest, to come raid the inducement, mitigate the decisional point of interest, or we see price further drop to the downside to come mitigate the extreme point of interest. So all this price movement we are seeing here are the internal range liquidity. We have the external range liquidity from this swing low to this swing high, from this swing low to this particular swing high. So this actually defines our external range liquidity. The external range liquidity are the major swing points, while the internal range liquidity are the minor swing points. So now you can see that the minor swing points are actually the minor structure movement within a major market structure. So now we have a change in market character. That doesn't mean that the market condition has changed from bullish to becoming bearish. So what price is actually doing here is to drop to the downside to come mitigate this decisional point of interest. So a lot of traders confuse this price movement and assume that once they see this change in market character from a lower time frame, they assume that the condition of the market has changed. Or once they see the rate of the inducement in the higher time frame, they assume that is a change in market character. So this is actually the ideal low point until price push to the downside and rate this low points before we can consider that as a reversal in the market's condition. So guys, now you can see that price return to mitigate this decisional point of interest. And then you can see we have the push of price to the upside. So basically all of this are just internal range liquidity. So you can see price broke structure to the upside. We have from the higher time frame this pullback that gave us our inducement. But then we do not have a return of price to the downside to come raid this and mitigate any form of sponsorship candle here. But then price push further to the upside. So since we do not have the rate of inducement, then we do not have a valid higher high point. But then now we have price drop to the downside and then raid these inducements. So we have a valid high point here. So now we're expecting the push of price to the upside. So guys, let me show you guys a more simplified example so that you can understand this concept before we head to the real-time chart example. So guys, let's look at this example so that you can actually understand better what I'm actually trying to pass out to you. So let's take this to be our 4-hour time frame. Now you can see that the market condition is actually bullish. We have our higher low point, we have the higher high, the higher low point, and then price created the new higher high point here. So what you're going to see is that we have the break of structure here. So meaning our external range liquidity is actually from this swing low to this swing high here. Now within the lower time frame, definitely within this expansive leg move, we're going to have this bullish market condition. So now when we actually see price drop to the downside and then we have a sweep of this low point, now we are actually having a minor change in market character. It is not a major change in market character yet until price pushes to the downside and then sweep this strong low point. Then we actually have a major change in market character. But what we have is that now price took out this liquidity resting here. Now you can see price push to the upside and then price further drop to the downside, took out this swing low liquidity. Just the way we've said, the market moves to grab external range liquidity, return again to fill up any form of inefficiency, and then take out internal range liquidities. So now you can see that now price again pulled back to the upside, returned to the downside, took out this low points. So what you're going to notice is that price took out the external range liquidity and then price is returning to the downside to fill up any form of inefficiency resting within the expansive leg move that gives us the internal range liquidity when we drop to a lower time frame, through marking out the minor structure within the expansive leg move. Now we can see now price is actually returning to mitigate the higher time frame point of interest. So this change in market character does not mean that the market condition has now changed from bullish to bearish. What we are just having is the pullback to come mitigate the higher time frame point of interest, and then you can see we have the push of price to the upside. So what we are going to notice is that price always moves to take out external range liquidity, return to fill up inefficiency, and also raid internal range liquidity. So the swing low points within the expansive leg move also act as our liquidity points. So they act as the sell side liquidity points. And see now price return to take out all the sell side liquidity, and then we have price push to the upside, and then price took out the external range liquidity. So this is what we are often going to be seeing in the market. A lot of traders make this mistake to assume that when they see a change in market character from a lower time frame, when the higher time frame major structure is actually bullish, they assume based on the lower time frame structure that the market is now bearish. Unknown to them that the market is pulling back to come mitigate a higher time frame point of interest before resuming with the major structure. So that is what we must actually learn to clarify when analyzing the price chart. So now guys, I'm going to take you guys to the real-time chart example so that you can have a practical understanding of this. So guys, let's head to the real-time chart example. So guys, before we head to the real-time chart example, please guys, if you're gaining value from this video, kindly click on the like button, comment in the comment section, and also if you're new to the YouTube channel, please kindly subscribe to our YouTube channel, as this encourages us to bring more content your way. So guys, let's head to the real-time chart example. As you can see from your screen, I've already marked out the structure here. This is actually the Great British Pound to the United States dollar. Now you can see this is actually a bearish market condition. You can see we have price raided the inducement, and then we have the expansive leg move that broke structure to the downside here. So we have our valid break of structure. We have a candle close below the swing low. As I've said guys, if you do not know how to mark out ideal institutional market structure, there is a video in the YouTube channel that actually teaches on how to mark out ideal institutional market structure. You can do well to check the description section to this video to get the link to that particular video. Now guys, you can see we have the expansive leg move. Now what you're going to see is this is where our inducement is resting. Now above our inducement, we have the decisional point of interest, and where we have price reacted a little, but price raided through the decisional point of interest and then to the extreme points of interest. And then we have our expansive leg move to the downside. So you can see that the range of this market condition is from this high point to this low point. So that is the external range liquidity. So you can see that price pushed to the downside, took out this external range liquidity, and then price returned to the upside to fill up any form of inefficiency here, and also to grab all liquidity resting within the expansive leg move. When we drop to a lower time frame, you're going to find structures within the expansive leg move. So this is actually our decisional point of interest. Now you can see price created a new lower high point. Price then pushed to the downside and then raided this external range liquidity. So in a bearish market condition, the market moves to raid the external range liquidity that is resting at the low point. So that is what you're going to see in a bearish market condition. The market pushes to the downside to break previous low points. Now you can see the expansive leg move raided this low point, which is the external range liquidity, because you have the range from this high to this low. Now price gave the pullback, took out any form of liquidity resting here. Now you see price dropped to the downside, and then we have a breaking structure. You can see we have our inducements here. We have our decisional point of interest here. Price return, fill up the fair value gap, did not really mitigate the order block resting here. And then we have the push up price to the downside. Now price, we have valid break of structure by this movement to the downside. This candle closed below this swing low, so we have a valid break of structure. Now price gave us the pullback after the valid break of structure, serving as our inducement. So this is our point of interest above the inducement. But what we can see is just price took out the inducement, and then we have a fall of price to the downside. We have price took out this external range liquidity, and then we have the pullback. Price took out the inducement, mitigated the decisional point of interest, and then you can see we have price falls to the downside. So we have the decisional point of interest, we have our extreme point of interest. So now when we drop to the lower time frame, you're going to be seeing that within this expansive leg move and also within the corrective leg move, you're going to be having a minor structure which actually serves as the internal range liquidity. So now let's drop to the 3-hour time frame. So guys, now this is the 3-hour time frame. We can see where price took out the inducements from the daily time frame, but from the 4-hour time frame, this is the inducement. So this is where we have the inducement that led to a change in market character and then gave us this bullish move to the upside. So now what you can see is that price dropped to the downside. This is the daily structure. So price took out this low points from the daily time frame. We'll have a break in market structure. We can see that within the 3-hour time frame, we are having this bearish move to the downside. We are having the bearish market structure because you can see we have the fall of price to the downside. Price pushed to the outside, raided the inducement. We have the fall of price. This is the inducement here. Price pushed to the outside, took out the inducement. We have our new lower high points. Price pushed to the downside, took out this lower low points, and then you can see this is the inducement here. Price pull back, took out the inducement. We have a new higher low point, and then we have price push to the downside. Now what you're going to see is this is our last structure point within the 3-hour time frame. You can see this is the daily decisional point of interest and then the extreme point of interest in the daily time frame. Now you can see the push of price to the upside here. We have a change in market character. So what you can see is price took out the external range liquidity, but then we now have the internal range liquidity. We have the internal range liquidity. We have fair value gaps, unfilled fair value gaps within this particular price movement. We have unfilled fair value gaps. So you can see price took out external range liquidity. Price is returning to fill up and raid internal range liquidity. So once some traders see this change in market character, they now possibly assume this is a reversal in the market. But this is not a reversal, because from the higher time frame, you would notice that we are having a bearish market condition. So this is just a pullback leg to come mitigate the decisional point of interest that we spotted out in the daily time frame, or to come mitigate the extreme point of interest. So now you can see that now price pushed to the upside. We have the pullback because price return rated the inducement resting here. Price gave us this push to the upside, came back to cut the inducement, push to the upside, came back to cut the inducement, and then we have price push to the upside. Now you can see this is the pullback before price gave us this impulsive move. So this is our inducement level. So you can now see price return and took out the inducement after price mitigated the extreme point of interest. Don't forget that the extreme point of interest was actually spotted out from daily time frame. So this is not a price reversal. This is price pulling back to come mitigate the decisional point of interest or the extreme point of interest. You can see we have the daily inducement resting here. So you can now see price came mitigated the extreme point of interest. So when price reach through the inducement, we have a change in market character. Why? Because price mitigated an extreme point of interest. So the inducement becomes where we can consider as our change in market character. You can see price closed below the low points. So you can see price fill up all forms of inefficiency, took out the swing high points, the serve as liquidity levels, and now you can see price came to mitigate the extreme point of interest. Now what you can see is that now price left internal range liquidities here. We have internal range liquidities here, and then we have the external range. So now what we're anticipating is to see price return to the downside to fill up any form of inefficiency here and take out all these swing low points and then break through this lower low points, which is actually the external liquidity. Why? Because we are in a bearish market condition. So whenever you're trading, you must learn to switch between time frames so that you can know the level you want to actually consider for your take profits, and also when you need to actually continue with the main directional bias when price return to the actual point of interest. So like in this condition, when you're seeing this pullback, you would want to take entry and then exit at the decisional point of interest level, or you want to exit at the extreme point of interest level. So this is what you want to actually be looking at for. So now you can now see that now we have price mitigated the extreme point of interest. We have the change in market character. Now in alignment to the directional bias. So what you're going to be expecting is the return, and then you trade where you actually fix your take profits below the swing low point, because you're trading in the direction of the trend. Now what you're going to see is that now we have a change in market character. Price give us the inducement here, because this is the pullback before the change in market character. This is the first inducement, but inducement transferred from this swing high to this swing high point. Now price took out the inducement. This is where we have the point of interest. Price now mitigated the point of interest, and then you see we have the fall of price to the downside. So we are expecting that price should come read this inducement here. Price broke through the daily inducement, which is also the level for the change in character in the 3-hour time frame. Now you can see price broke through this. We have the pullback, and now you can see price came to the decisional point of interest that we marked out in the daily time frame. Now price fell to the downside. You can now see we have change in market character. So now price have realigned itself to the directional bias. So what you'll be expecting is the pullback to take your entry, your stop loss above, and then we ride with price to the downside. So this is how you want to be identifying your internal range liquidity and your external range liquidity. You must be able to switch between time frames when trading in order for you to have a broader perspective of the market's condition. So guys, if this video added value to your knowledge regarding the internal range and then the external range liquidity, please guys, kindly like this video, share and subscribe if you're new to this YouTube channel. In the next video, we're going to look at chart replay so that we can see how to mark out internal and external range liquidities and also how to take entries. So cheers guys, and God bless you.